Hey everyone, hope you guys are doing well. Once again, thank you for tuning into our channel. I'm Hector Aguilar, and this is
Ben, your agent.
of Aguilar Realty Group. We're grateful that you're joining us, and we're looking forward to sharing today's topic, which is the changes that are coming to the California Residential Purchase Agreement this coming month of December.
Yes.
Ben, you and I have been in classes with our broker, and tons of changes coming, right?
Pretty exciting changes, Hector.
Yeah,
Definitely.
and at first when you look at it, it's going to look a little scary, but honestly, I think they did a fantastic job on the contract. There's a
Yes.
section there that actually looks like a summary, and it's going to be really, really easy for buyers to go through it and understand the offer in a better way, and it's going to simplify the process too. What do you think, Ben?
Yeah, I love it. I mean, the simplicity of it too, and the clarity for both ends, for everyone to understand is great. Thank you.
Absolutely. Just so that you know, currently the RPA is a 10-page document. With the new changes coming, I'll let you know it's going to be a little longer. It's going to be 16 pages. And don't be afraid, it's not overwhelming. It's just they added in some additional pages because of some of the summaries that you and I will be reviewing today. So, great
Yeah.
things coming. The purpose of the contract is obviously to make sure that the buyers and sellers understand the offer price, the terms, their agreement, their contingency. So, let's go ahead and get started, Ben. I'm going to go ahead and share the document. And Ben, why don't you do me a favor? Why don't you go ahead and go over the first section of the contract, which is the offer section, section one. Ben, take it away.
Love this section. So first thing is, what is the offer? Buyers, you need to know what the offer is and where it's coming from. So it's definitely going to be your name, purchaser, right there on the first line at 1A. And then 1B is going to be the address, the city, the state, and the zip code right there. And then the assessor parcel note number, which we get easily. And then 1C, the terms of the purchase are specific in following the pages below. D, buyers and sellers are referred to herein. The parties, brokers, and agents are not parties to this agreement. So it goes directly to number two.
Hold on a
Two,
second, Ben. Before we go on to section two, I wanted to explain why the APN is an important piece of your contract.
okay.
For those that don't know, typically the actual address to the property really is an address that identifies the location of the property, mainly in terms of mailing, Amazon deliveries, excuse me, U.S. Postal Service, things of that nature. What actually identifies your property as being your property is the county assessor's parcel number that's associated with that property. So it's if you're wondering why that's important, that's what the county will reference when they assign ownership to that particular property. So before we go on, I just wanted to cover that, Ben. Go ahead,
Oh,
Ben.
that's
Cover
good.
section number two, which talks about agency.
Yeah, so agency is disclosing all parties. Basically, that's what it says right there. And B is confirming which parties are who. So seller's brokerage firm will usually be the listing agent, and they're gonna usually put with the new contract. With this contract, is they're gonna select. Um, they're gonna put their name, brokerage firm, their brokerage number. Then they're gonna put select check one, the seller,
Mm-hmm.
unless they're representing both sides, which is if it's with EXP on both sides, then we learned that it's going to be both the buyer and the seller dual
Mm-hmm.
agents. So if it's two different brokerages, then we put it in accordingly, whatever is supposed to be on the seller and buyer. And then
Exactly.
if there's more than one brokerage represent, then C, 2C, and then D is just acknowledge that there might be a possible representative of more than one buyer or one seller. And then
Fantastic.
Hector, take it away.
So I wanted to kind of reaffirm something with regards to confirmation of agency. So California is one of a few states that allows dual agency. And what does that
Yeah.
mean? It basically means that the same broker can represent the seller and also the buyer. There are two distinct differences in dual agency. Number one is, let's say I have a contract with the seller to represent him on a sale, and my brokerage or our brokerage is eXp Realty. So I would check off that EXP Realty and the brokerage license number. checks off the seller, represents, the seller, and I would put my name with my license. Now, if I was a dual agent, I would check off both buyer and seller. However,
Yes.
let's just say Ben is representing the buyer, right? Then
Yeah.
Ben would have to notify it that he would have put his name here under buyer's agent with his license number. Now, we're two different agents. Ben is representing the buyer, and I'm representing the seller, but there's only one brokerage, which is eXp Realty in this case. So we would be a dual agent in terms of brokerage, but we wouldn't be a dual agent in terms of who's representing who. Okay.
Right.
The other example of dual agency is whereby if I have the listing and I'm the broker of record with eXp Realty, and through an open house or maybe a marketing campaign that I'm doing to sell the property, expose the property, I'm able to find a buyer for it, then I would be also a dual agent in the terms that I would represent the buyer as well. Now,
Right.
note, there are protections for sellers and for buyers. Obviously, we represent them in their best capacity. We want to make sure that we provide unbiased service to each, because truly the contract is between the seller and the buyer, not necessarily
Yeah.
the brokerage. But California does allow us to be a dual brokerage. Just wanted to explain that a little bit just so that you guys understood the differences between dual agency and what those might mean. Okay.
Wonderful.
Moving on to section number 3, which is really where we're going to spend most of our time. There's a big difference today in the contract as to what it covers, right? So we're gonna go over the newest section of this contract, which looks like a table, kind of looks confusing, but it's really, really simple. So I wanted to go over that really quick with you. Um, Basically, what it is, it's going to be the terms of purchase and allocation of cost. Now, the items in this paragraph are contractual terms of the agreement. Reference paragraphs provide further explanation. This form is 16 pages, and the parties are advised to read all 16 pages. So, who are the parties? The seller is a party, and the buyer is a party. Okay. Our job is to represent you, to go over the contract, but keep in mind, buyer and seller are parties to the contract. We are not a party to the contract as an
Right.
agency. All right. So you'll see in this first table in section A, 3A, paragraph 5 is going to talk about the purchase price. So here you put the purchase price. And if it's an all cash transaction, your buyer is an investor, or he wants to buy the property all cash, you would just simply check off all cash in that box, and that would be done. Okay. Then in
Yeah.
section B, again, under paragraph 5, it talks about close of escrow. Are you going to do 30 days after acceptance, or are you going to do a specific date? You would notate it here, and it would be under paragraph 5 in section B. Okay. Section C talks about expiration of offer. Most buyers aren't aware that an offer has a lifespan of 3 calendar days, which means
Yes.
that once the offer is made, the seller has 3 days, 3 calendar days to respond to our offer, to either reject it, um, respond to it through either a counteroffer or seller multiple counteroffer, or they can elect not to respond to us at all, right? So it does have
Right.
an expiration of offer. Typically, it's 3 calendar days, or you can actually make it date specific with a specific time, and that's going to be under section in the paragraph 32A further in the contract. Okay. Section D is going to talk about your initial deposit. Now, in the state of California, it stipulates that you have to have collateral for a contract to be effective and enforceable. So collateral basically could mean something of value. It could be a classic car, it could be a horse, it could be a barn, it could be any one of those things. However, for the purposes of most contracts, it typically ends up being an initial deposit. In most cases, it could be 3% of your purchase price. And I'll explain why 3% a little bit later, but you would put the amount here, see how it says percent of purchase price, and that initial deposit actually is going to be part of your entire down payment. So if you're financing 5%, if you're financing 10% or 20%, that initial deposit is going to be inclusive of that 20% down if you're financing the purchase. Okay. It does say here that the buyer is obligated, if I'm not mistaken, actually with certainty, that the earnest money deposit has to be delivered to the escrow company either by wire, or it could be a personal check or a cashier's check, and you would check off this box. It has to be done in 3 business days. So for example, let's say your offer got accepted on Thursday. Well, Thursday is not day 1. Thursday is day 0 according to the contract. So the first day would be Friday, the second business day would be Monday, and then the third business day would be Tuesday. So you would have until Tuesday of the following week to wire your initial money deposit into escrow. Now, if for whatever reason you fail to do so, the seller can send you what's called a notice to buyer to perform to deliver that earnest money deposit within 24 to 48 hours. That's something that you want to avoid, right? As a buyer, just go ahead and send the wire in. We'll get it into escrow, and then we'll move on to the next steps of your contract and your contingencies. Moving on to the next area of the contract, we look at increased deposits. Now, why would you want to do an increased deposit? Let's just say that you wanted to do, for whatever reason, you wanted to increase your deposit because you sold the property. Initially, you only had a certain amount of dollars in your bank account that were free to you. And then you sold your property. Now you have all this equity that came in, and now you can make an additional deposit. So that's what this particular section would be. You would notify the seller's agent that there's going to be an increased deposit after a certain time period, and you would notate it here. Okay. Now,
And that was obviously a question. Real quick question: if they have an initial increased deposit, does that obviously changes the purchase price or anything? Not the purchase price, but the loan side of things.
It does not. Remember, we're going into the transaction knowing from upfront is how much down payment they're going to be putting down. So when you get your letter of approval, your lender is going to tell you, look, this particular client is qualified for this price with this type of down payment and this type of interest rate. So it's not going to change their loan terms. It's just going to change their deposit. So for example, if a seller's agent wanted at least a 3% as a deposit, but the client only had 1% and they're expecting their money from, let's say, the sale of a property to come in, we could let them know, hey, in 2 weeks, we're going to close and we'll be willing to increase our deposit to meet your 3% requirement. But it wouldn't change the amount of their loan that they're financing. Okay? Good question, Ben.
Okay. Yeah.
All right. Speaking of financing, let's move on to the next section, which is loan amount. In this particular section, you're going to find it under paragraph 5C1. You're going to determine, okay, what's your down payment? How much are you financing? Are you using a fixed rate loan, an adjustable rate loan? And how much fees are you paying or points are you paying? And also the loan contingency. And I want you to keep a side note as to contingencies because we're going to talk about that a little bit later. Here in this section, you're also going to let the seller know like what type of financing are you going to do FHA? Are you doing a VA loan, which is for veterans affair loans, for men and women, that are in service or that have retired from the service and are eligible for those loans? Or are you selecting seller finance? Now, if you're using a conventional loan, you'll see that it's automatically defaulted here in the conventional loan. So you don't have to check anything off, right? So you're going to tell the seller what type of financing that you're going to use. Now, it's super important that you understand as a buyer is that if a seller accepts your purchase price or your contract under a certain terms of finance, you have to stick to those terms. If for whatever reason down the road, Ben, you have to change your program, guess what? You have to notify the seller and the seller has to approve the change. Otherwise, the seller can actually cancel because he didn't accept your offer under those new finance terms. So just note to buyers and to agents that could be possible. All right. So it's super important to note that. Notate that.
That's good.
Now, if they're going to use additional financing, let's say a second loan or a down payment assistance loan or any other type of secondary financing, then you would inform the seller that they are, and you would put the information here, and you can find additional information under paragraph 5C as to an explanation. Okay.
Does gifting from a family member or something happen to be right here?
It would not actually. This would be for let's say a second loan. Sometimes in our industry, we've heard of what's called an 80-10-10. What is that? It's an 80% first loan, a 10% second loan, and then a 10% down payment from the buyer. So that 10%, that 80-10-10, this is where you'd notate that you're using a secondary loan in addition to your first loan to let the seller know, like, look, I'm going to be using two loans to finance my purchase. So this is where you would put it, and it wouldn't affect either their loan amount or their loan terms or their loan type. Okay,
this like a HELOC, like a HELOC.
Exactly, like a HELOC. Now, a HELOC is a little different, Ben. Similar concept, but a HELOC is, for those that don't know, it's a home equity line of credit. And basically, homeowners take those out with their traditional banks like Chase, Wells Fargo, and other traditional banks in order to use that for improving the home, maybe reducing their debt. This is more an acquisition loan. It's what we call a second TD or a second trust deed, and it would go in this particular section, Ben. So great question.
Thank
All
you.
right, moving on to section 7, occupancy type. Again, are you going to occupy it as your primary residence? You'll see that it's defaulted there in this particular section. Or is it going to be a secondary home? What's a
I
secondary
love
home,
that.
Ben? That's going to be,
Secondary.
what's
Yeah,
a secondary home, Ben?
it's like a casita.
That's right. It's going to be like a vacation home. It's going to be a condo at the beach, or is it going to be
Yeah,
like a cabin up in the lake? So
yeah,
that's going to be, and the reason why you want to notate that is because it does have effect on your financing. Or is it going to be an investment? Investment could be a rental primarily, or it could be a short-term rental property where you're going to Airbnb it or VRBO if it's allowed in the city, right? So just check off occupancy. You'll see it under section 7A of the contract. Now, this section F here basically is going to be the balance of the down payment. So, for example, if we're financing $500,000 and you're putting 20% down, let's say you put 20% down as your, $20,000 down as your earnest money deposit. That means that this section would be $80,000 and your total price would be still $500,000. So I just
got it.
wanted to put it in this table to make it easier for buyers to understand every section of their contract and where to find it. That's the key thing is I like about this new contract is it tells the buyers what paragraph to find it in right
Yeah,
in here. So it's actually pretty cool. I like it.
I love it. Yeah.
All right. So moving down to the next page of the contract, it's going to talk about on section G, seller credits. Now, in this particular market,
Oh, yeah.
we're not seeing a whole lot of seller credits, right? Why? Because inventory is low and there's a lot of demand. So typically sellers are not crediting anything towards buyer's closing cost or repairs. Now, if there is a negotiation, you would put it here and you would find the explanation to that particular paragraph under 5E. Okay. Now, additional financing terms. In this section, you would type out, whether or not there is going to be a credit, what that credit is going to be for, whether it's for closing costs or prepaid items. It would be included here in this section under additional finance terms. Okay. Now moving forward under section 5B, or pardon me, section H1, which is in paragraph 5B, verification of all cash funds, right? Now, if you checked off that it was an all cash purchase, we have to provide the seller and the seller's agents a copy of a bank statement that shows proof of funds available, sufficient funds available to purchase that property cash. Okay.
Quick question.
Yes.
So the all cash verification is showing in their obviously bank account of the whole amount, correct? The
Correct.
whole purchase amount.
Correct. So
Okay.
in this case, let's say they offered 500,000. I like 500 because it's nice and round. It's simple. We would have to have a bank statement from that shows that they at least have 500,000, and honestly, probably a little more. Why? Because they're going to have to pay for their escrow fees. Maybe they're going to have to pay for their upfront taxes due, and other little fees that are part of the purchase transaction. So we want to see a bank statement. Probably it would have maybe 550 or so, just a little bit of a pad there. So good question, Ben. Now, if you are financing the purchase, section H2 talks about the verification of down payment and closing costs. So again, using our example of 500,000, let's just say that we're putting 20% down. We need to demonstrate through a bank statement that the buyer has the $100,000 down plus probably a little bit more, maybe an extra 15 or 20,000 to show that they have enough for down payment and their closing costs and escrow. Okay.
Yes.
Now, section H3 talks about verification of loan application.
Yes.
Basically, that means that they have shown proof that they've talked to a lender and that they have the ability to get a loan to purchase the property. Now, there's something new that actually was added on the contract that will be effective December. Now, we don't know exactly what date it's going to go into effect. Some say it's the 14th, some say it's the 16th, but it is going to be in December. So when that new date comes out, believe us, you will be notified. So one of the new things that we saw, Ben, that we learned just recently in reviewing and preparing for this new contract is there's this new box that says pre-qualification. Now,
yeah.
I want consumers to know that there is a distinct difference between pre-qualification and pre-approval.
Yeah.
Okay. A pre-qualification typically will be you spoke to a lender, you verbally gave them your FICO scores, you verbally gave them some income information, and you verbally told them that how much money you have. So based on that information, that verbal information, the loan officer would likely be able to tell you, yes, you're approved for this amount, or at least you're pre-qualified.
Yeah.
correction, pre-qualified for this amount. And that's when you would check here. Look, the seller is entitled to know that you've only been pre-qualified and not necessarily pre-approved. Now,
And it's good.
go ahead, Ben.
No, I was just gonna say a little break. It's just so you guys that are seeing this is it's really important when you're either pre-qualified, pre-approved, or fully underwritten, because what makes a stronger offer is what I think maybe Hector's going to share right now is one of those three, right? So
Absolutely. So the difference between pre-qualification and pre-approval is that not only did you verbally tell your loan officer, your income, your credit, and your FICO scores, now you've actually given them proof. So you've submitted your W-2s, you've submitted your pay stubs. The loan officer actually ran your credit to confirm your FICO. And now, based on that information that you actually delivered to them, they can actually issue you what's called a pre-approval letter. Now, the
yes,
difference between pre-approval and fully underwritten is now they've actually taken all your income information, they've submitted it electronically through what's called a desktop underwriter or loan prospector. It's an automated credit approval system that will generate an actual fully underwritten pre-approval. Now, that underwriter approval or electronic approval may still require a physical underwriter for the bank to review it and give it the final stamp of approval, right? So there's three different ways that you can notify the seller that you're either pre-qualified, pre-approved, and fully underwritten. Of course, to have strength of borrower or show strength to the seller, being fully underwritten approval is probably the best choice. Second best is pre-approval, and of course, lastly is going to be pre-qualification. So just so that you
yes,
know, that's what that section under H3 talks about, verification of your loan application, okay? Now,
sweet,
moving on to moving on to section J of the contract, which is under paragraph 16, is the final verification of condition. This hasn't changed. Typically, a buyer will have the right to do a final walkthrough inspection of the property within 5 days of closing to verify that the property is in the same condition that they saw it when they initially made their deposit, or their offer. So, sometimes in years past, sellers were known to maybe pull cabinets, change the flooring, maybe take the windows, just some horror stories that we knew in the past. And so the CAR attorneys and their wisdom implement this step so that buyers could verify that the property they're buying was actually going to be in the same condition as when they made their offer. So that's what that talks about.
that's
Now,
great.
section 23 is an assignment request, right? And an assignment request has to do with there are some buyers that are either institutional buyers or investor buyers that will go out and tie up a property in escrow and will let the seller know, hey, I'm buying this property in my entity, typically an LLC or a corporation, and they go out and they cannot close on the deal. So that what they'll do is they'll find another investor and they'll be able to assign the contract. Now, this new section actually lets the investor know or the buyer know that they only have 17 days in order to request if they can assign the contract, right? So
Right,
if the seller doesn't approve of that assignment, guess what? That buyer is either going to have to cancel or they're going to have to completely complete the purchase contract when it comes to purchasing that property. Okay. Moving on to contingencies. This is probably the biggest change that we'll see. And go ahead and flag that next special note there, Ben, for me. So currently, as the contract states, there's these numbers 14, 17, and 21 days for contingency. So what does that mean? 14 days right now means that the buyer has 14 days from the days of acceptance, from the day of acceptance of their contract, to remove their physical contingency, to do their inspections, whether it's plumbing, roof, electrical, their general inspections, any detailed inspections. They currently have 14 days, unless negotiated shorter, to do those inspections and remove that contingency. 17 days are currently in place to remove your loan contingency, which means that from the day of acceptance, you have 17 days to get your full loan approval so that you can remove that protection or contingency in 17 days. And 21 means 21 days for appraisal contingencies. Now, basically what that means is that you have 21 days to get the appraisal on the property to make sure that the property is either worth what you're paying for the property so the bank can finance it, right? And in
right,
this market, to be honest with you, there's a couple things that are happening. Number one is sellers are asking for a shorter inspection contingency. We've seen 7 to 10 days.
Yeah.
They're also asking for a shorter appraisal contingency. How many
Yeah.
days, more or less, Ben, are we seeing on appraisal contingencies?
Oh man,
I think
I
I've
just
seen
know
like
they're
10. I think
like
I've seen like 14, something
I
like that, right?
just for me, I've seen no appraisal contingencies.
Yeah, you're absolutely right, Ben. I'm glad that you mentioned that. And in this market, we're seeing no appraisal contingencies, Ben. What does that mean, no appraisal contingency?
Basically, you're allowing the buyers understanding that whatever the appraisal comes in, whether it's above or below, they're willing to cover the difference. Easy
Correct.
said.
So again, if we're going to go back to our example we're using today, if you agreed on a contract price of 500 per se, and the property appraised for 480, you are committed as a buyer to bridge that gap. You're going to have to bring in an additional 20 grand because you waive your appraisal contingency. And in this market, we're seeing a lot of that. Just because there's a lot of competition, so buyers are offering more money for the property, and sellers are actually accepting their offers, but telling them, hey, whether the property appraises for the price you're offering, you're still going to pay me the price you're offering. So buyers have to understand that they're bridging that gap. And that's what that means. So with
Right.
this new contract, you'll see here in the section here that most of it has now defaulted to basically 17 days across the board. Inspections, appraisal, and loan contingency. And the reason they did that was just to understand that to standardize those days and not have the confusion of the 3 days from before. So really cool feature. Again, that's negotiable depending on the market, depending on the sellers, and depending on whether or not the buyer wants to accept it or not. Everything is negotiable, but they just standardize the contingencies you can see here. Everything from reports to preliminary title reports to natural hazard disclosures to the common interest disclosures, which is condos, PUDs, or even gated communities that might have CCNRs, those kind of things. So they standardize the contingencies to be 17 days. Okay, moving on to the page 2 of this contract is possession. Here you're just notifying when possession is going to happen. Typically, it'll say upon notice of recordation, which means that if the deed has recorded in the county, which confirms the illegal transfer of one owner to the new owner, then delivery will be made then. Or number 2 could be at 6 p.m. You can check it off 6 p.m. of that day. And what that does is it allows the seller a few hours to gather their things and deliver the keys to the agent so they can deliver the keys to the new owner. Or you can actually stipulate a date. It could be 3 days after close of escrow. It could be 2 days after close of escrow. Again, you would insert it here and it would determine what the time of possession of the property is. That is if the property is vacant or tenant occupied and it's going to be delivered vacant, right? You'll see under section 7C here, or part of M2 and paragraph 7C, it talks about seller occupied or vacant units. This is going to be in the event that a seller needs to remain in the property for less than 29 days. They recommend checking off this particular section here. And why would a seller need to stay, right? If a seller needs to stay, it's because they're selling to buy another home, and they're probably going to close escrow contingent, and they're going to need that time in order to be able to close their escrow and be able to move into their new property, okay? There are some occasions where a seller will need to stay in a property maybe more than 30 days. We've seen those with new construction, right, Ben?
Yeah.
And why is that, Ben? Why with new construction do they need to stay in longer?
Well, because they're being built and this takes time. I mean,
Absolutely.
definitely.
Sometimes those new construction homes aren't going to be ready for maybe like 2 or 3 months down the road. But here's what happens is new construction builders, they don't necessarily like to accept offers from contingent sellers or buyers, pardon me. So what a seller has to do is they have to sell their property, free up their equity, and then tell the builder, hey, I've got all my equity in the bank. I'm ready to roll. And then the builder will accept their offer. But the seller will negotiate with the new buyer of their property that, hey, I'm buying a new home. I'm going to need 60, 90 days to stay in the home. So this is where you would use, that the seller is going to remain in possession for more than 30 days. There's a couple of different contracts depending on if it's 29 days or less, or if it's 30 days or less that you have to use in addition to your contract. And again, it explains it under section M2 of the contract. Okay. Now, if you're buying units, say 2 to 4 units, then and some of the tenants are going to stay, then you would check that off. There would be a tenant occupied occupied property addendum attached to it, which will tell you the details of those tenants. Okay. So typically you're going to see
Fantastic.
that either if it's an investment property or if it's 2 to 4 units.
Got it.
Okay. Now, documents, fees, compliance, right? So this hasn't changed too much. In fact, it hasn't changed at all. Basically, the timelines for the seller to deliver documents is still 7 days from acceptance. And what documents are we talking about, Ben?
I'm thinking all the
Disclosures.
disclosures.
Yes,
Okay.
good job, Ben. Good job. Disclosures. So the disclosures have to be delivered to the buyers within 7 days. That hasn't changed. The buyers have to sign escrow instruction, general provisions, typically within 5 days or less. Okay. They have to pay HOA fees. If there's HOA fees on the property, there might be an HOA certification fee, or the seller has to pay an HOA transfer document fee. The sellers would have to pay that within 3 days and deliver those documents as well. Okay.
Got
And then within 7 days, they agree to install any state mandated items like smoke alarms, smoke detectors, carbon monoxide detectors, and make sure that the water heater is braced. That has to be typically done within 7 days. Okay.
I
Moving
love
on
the
to our,
clarity there. It's just right there, the clarity as the contract now is not doesn't tell them like, hey, this is what is needed by state mandate, right?
well,
So
it actually does, and that's what I like about this new contract. It does state it, but what happens is now they've actually summarized it and actually pointed the buyer to the section and the seller to the section as to where the paragraph that stipulates these particular timelines in the contract. So now they've kind of brought it out to light. They've put it in their summary, and now it's easier to find in the contract. And that's one of the reasons why they modified the contract, is they wanted to bring clarity to both the buyer and the seller, and kind of point them in the right direction as to where they can find additional information within the contract that pertains to this particular term. So thanks for
great.
pointing that out, Ben. All right, in the next page of the contract, which is page 3 of the contract, it's just going to stipulate as to what items are included, right? Some, whether the stove is included, the refrigerator, there's a wine fridge, if there's a washer and dryer, dishwashers, any video items, a video doorbell like Ring or
That's
Vivid,
new.
right? Or any security camera equipment. And actually, I'm really glad to see this because we just sold Van on Vine in West Covina.
Yeah.
What was the experience on Vine as far as all the security items?
Yeah. I mean, they wanted to keep the security cameras from the outside, but the inside is fine, right? I mean,
Right. So
vice versa.
it was vice
They
versa.
wanted,
So the sellers of this particular property had some cameras and camera equipment and some electronics that actually monitored the interior of the home, and they wanted to keep those, right? So if
yeah,
they would have been included, we would have checked them off here. Now, if it needs more explanation, you mentioned the outside. They did want to leave their cameras on the outside. So here they would have checked security systems other than separate video doorbell equipment would have been included, and we would have made an explanation here. Video cameras on the exterior are going to remain with the property, right? So
yeah,
we want to clarify that. Anyway, great section tells the buyers exactly what's going to be included as far as these items, and they don't have to go, all over the contract to figure it out. I think it's pretty self-explanatory.
clear, yeah,
Now, in this next section is allocation of costs. So there's a natural hazard disclosure that needs to be provided to a buyer. It just tells you, okay, who's going to pay for it. Typically, the NHD is paid for by the seller or can be negotiated, right? If there's a wood destroying pest inspection report that needs to be delivered because the buyer wants to know whether or not the property is infested with either termites or other wood destroying items that affect the property, the buyer can request for the seller to provide one. Under Q3, here we would write in like a physical inspection, which the buyer typically pays for on a physical inspection. So we would put it here and check that off. Again, with regards to smoke detectors, carbon monoxide detectors, and water heaters, we want to make sure that the seller pays for those, and those are state mandates. So typically you check them off. They are negotiable, but in order to protect the buyer, we always ask the seller to make sure that those are installed. And any government required point of sale inspections or reports. Now, we currently don't have very many of those, but there are, I want to say, a few cities that come to mind that have inspection reports that are pre-sale reports. For example, Santa Monica, Azusa has one. I want to say that Pasadena also requires one. So there are a few cities. If you're not familiar with which cities require it, don't worry about it. Your escrow company that you're working with will naturally have a list of those cities and will inform us. Okay. I have a list as well too. So every time we're looking at a certain property, I make sure to check, and I can provide you a copy, or we can provide you a copy of the list of cities that require a pre-sale inspection before selling. Okay. Now, there might be other government required point of sales when it comes to corrective or remedial actions. Like if there needs to be improvements or modifications, maybe maybe the city of Azusa may have flagged a property that had an unpermitted addition in their report. Well, that has to be corrected before we can sell. So you would put it here, and you would put who's going to pay for those repairs and improvements. Okay, you're going to determine escrow fees. Usually, both will pay each of their own fees. Okay, or in this market, buyers can negotiate and offer to pay the seller fees as well. Both buyer and seller have their own escrow fees. So if a buyer wants to be aggressive on their offer, they could offer to pay the seller fees as well. Okay. The owner's title insurance policy typically is paid by both parties. You would check it here or both. If either one wants to pay for it or both, which is typical. And what is title insurance? It's basically a title insurance is going to study and review all the documents and liens that are recorded against your property to make sure that when it's transferred to the new ownership, that there are no clouds on title or no liens that are transferred from the previous owner to the new owner, so that there's only two things that are going to be recorded against the new ownership, which is their financing, if they have any, and their new tax rate. Pretty much it. Okay. A buyer also have a lender's title insurance policy that's going to protect them in their loan. Typically, the buyer will pay for that, and it's part of their buyer fees. Again, county transfer taxes and city transfer taxes. There are some cities. So depending on the county, every county has a transfer tax rate when you're selling. Typically, the seller will pay for that. Also, city transfer taxes. There are some cities like the city of Pomona has a transfer tax. The city of Los Angeles has an additional transfer tax. Again, typically the seller will pay for that unless the buyer wants to have a strong offer, kind of stand out from the crowd and offer to pay the seller's transfer fees. They can note it here as well. If there's any HOA prep disclosures, the seller pays for them. Here it's good to note the certification fee typically is going to be asked by the lender. So because the lender requires an HOA certification fee, the buyer will typically pay for that up front so that the lender can get the certification from the HOA and be able to approve their loan. Okay. Now, as far as
Okay.
what happened, Ben?
No, I said okay. I agree. I didn't
Okay.
know.
So yeah, no, it's and this is one of the reasons why we're going through it, right? So the HOA transfer fees, typically those are paid from the seller, or if otherwise agreed, maybe the buyer might pay for them too. Okay, and you can find additional information under paragraph 11K when it comes to HOA of the contract. Now, moving on to section Q15, private transfer fees. Many sellers and buyers maybe haven't heard of this, right? So what are
Mm-hmm.
private transfer fees? Let me explain. Ben is a new home certified home agent. He's actually been trained and certified to represent buyers in new home construction. But oftentimes, when buyers buy new homes, they're not aware that in their contracts, they're agreeing to what's called a private transfer fee. What does that mean? Let's simplify that. It basically means that if they choose to sell the property at some future point, those sellers are going to be obligated to pay an additional transfer fee to the county or the city where that property is located. And that's going to be different from your normal tax transfer fees that you find at the top here that we discussed earlier, because those are private transfer fees that are associated with new home construction. So it's different from either county or city transfer fees if there is any, and it has to do with new construction. So just let your sellers, let your owners be aware that if they do buy new construction at some point, they may have those private transfer fees. And typically the seller will pay for it unless the buyer is willing to pay for it. Okay.
Right.
And then again, finally, the home warranty plan. It's traditional or customary for the seller to pay for that. But in this market, the buyer may want to pay for his own home warranty plan. Oh man, that was a tongue twister. Say that again. Right? They might decide to pay their own home warranty plan. And so you would check it off here, and then you would put the amount and who it would be issued by, right? I don't really recommend that the buyer waives a home warranty plan. They can waive it. In some cases, investors that are buying properties that they're going to rehab, they don't need a home warranty because they're going to gut the property, they're going to remodel it. And so typically they'll decline the home warranty. That's the only case that I've seen where a home warranty is waived by a buyer. So in a nutshell, those are the first 3 pages of the contract. I really don't see the need to, to go over every section of the contract. Why? Because every other section in this contract is going to be pretty self-explanatory, whether it's a property that's a probate property, a manufactured home purchase, a tenant-occupied property. These will all have certain addendums that are attached to it, and it'll be part of your contract. My recommendations to you is for you as a buyer to make sure that you review the contract. It is our obligation to provide it to you, and if you have any questions, that we can clarify those questions for you. But these are some of the changes that are coming to our purchase contract here in the state of California. I wanted to review those with you. I wanted to thank you for setting up some time. I know it's a longer video than usual, but it's well worth the 40 minutes of your time to learn what new changes are coming to the contract. Anything else in closing, Ben?
No, that was good. Thank you.
My pleasure, Ben. Hey, I always appreciate Ben being part of my recordings and all the value that we bring to you on our videos. I know a lot of times Ben stays kind of on the sidelines, but I got to be honest with you. Ben is the one who has encouraged me quite a bit to kind of get out of my comfort zone and to start providing value to you guys in our videos. So Ben, I'm really in your debt. Thank you for being my strong arm and my inspiration as far as videos. I hope you guys enjoyed this video. If you have any further questions about the contract, or if you're looking to buy or sell in our local market in Southern California, we're in the LA market, please give us a call. We'd love to talk to you and chat, have a buyer consultation. We can have it in person. If you're uncomfortable with that, we can have it through Zoom. And we'd love an opportunity to serve you to either buy or sell your next home here in Southern California. Once again, I'm Hector Aguilar of the Aguilar Realty Group, along with
Ben, your agent.
Thanks again for joining us, and we'll see you next time. Take care.
Thank you, everyone.
Thank you.